Ladies and gentlemen, I really would like to, with a pleasure, to announce the next presentation. That will be a presentation of Gareth Payne. He's the Senior Portfolio Manager of Pictet Asset Management, and he will talk about distressed debt. This will be a video pre-recorded, and well, that we can see here, and afterwards we'll have the Q&A with Gareth, who is already present, as I can see. Hi, Gareth. So please, let's start the video. Yeah.
My name's Gareth Payne, and I work in the distressed and special situations team at Pictet Asset Management. And over the next few minutes, I just want to talk about this very interesting time in markets, particularly in the distressed space, and just set out a little bit of what we're thinking and what we're seeing in the space at the moment. There were a lot of red flags and signals that we were seeing, even towards the end of 2019 and into 2020, such as the rise of covenant-light loans, the number of zombie companies out there that were not covering their interest payments with their earnings, the aggressive accounting strategies such as earnings add-backs and adjustments that we were seeing, and also the general leverage levels that had crept up in the market to levels that were similar to that of the Great Financial Crisis. Now, of course, COVID did hit in March, and we did see a real spike in distress levels. So approaching 40% of the European high yield market and around slightly less in the US of bonds trading at distress levels. That is to say, trading at a spread of over 1,000 basis points or at a price of sub 80 cents on the dollar. This has since fallen away in the face of unprecedented liquidity from central banks. However, there is still a lot of lingering effects from this that we think will continue to create opportunities in coming quarters. As the fundamental outlook declines for many companies and their ability to generate profits declines, they have been downgraded by the ratings agencies. And one clear example of this is the increase of CCC rated companies in Europe and the US, the lowest rating within credit ratings. And that to us, again, is a sign that there is more distress and more dislocation to come. And what about the next step from downgrades? Downgrades are a very clear leading indicator. They correlate very highly with defaults, with corporate credit defaults and credit events such as restructurings that will follow from that. And we have already seen a material increase in defaults in the US. And we're starting to see defaults creeping up in Europe. We think that there are more of these to come, and Moody's and the other ratings agencies' general expectations are for close to double-digit defaults in the coming cycle. And again, this creates a very strong opportunity set for a distressed and special situation strategy. On the other side of the coin, it's important to recognize the fact that we have seen an unprecedented amount of central bank liquidity being injected into markets. This has had a lot of effects in terms of distorting the market. And ultimately, what we think is that this will only go on to prolong the distress cycle and to prolong the default cycle and the pain for many corporates. This injection of liquidity can't solve the liquidity and solvency problems for many issuers. But it's definitely something that we're bearing in mind and something that's clearly having a huge impact in terms of risk sentiment in markets. So where does that leave us? Well, as I said before, we came into this crisis with quite a lot of fragility already under the surface in credit markets. And really what the COVID crisis has done is exacerbated a lot of these cracks and a lot of this fragility for many companies and for many balance sheets. This aggressive accounting standards that we saw and all of the other red flags that we saw are still not going to go away. And in many cases, such as leverage, in fact, companies are going to emerge from this crisis with more leverage than they already had. And in that respect, we think that this unprecedented liquidity injection and these huge numbers in terms of easing and accommodative policy will actually just go on to prolong this distress cycle. And the upshot of this is that for distressed and special situation strategies, this is a very, very exciting time because there's going to be a lot of opportunities to generate alpha, a lot of opportunities in terms of exploring for performance for our investors in the coming quarters and into next year.
Okay, there we had the presentation. Thank you, Gareth, present at, I think, at home. I would like to invite Han to kick off with his questions.
Yeah, Gareth, thank you very much. Given the trend toward online shopping, online working, online learning, it seems that a lot of real estate is now into distress because of these buildings are not occupied anymore. What's your view on real estate distressed assets?
Yeah, hi, Anne. It's a very good question. It's something we're spending a lot of time looking at, and you're right. Distress levels in that sector really are picking up. We saw the collapse of Into, which is the UK's kind of largest shopping mall operator, listed company, that collapsed in recent weeks. The REITs, the commercial real estate and retail exposed REITs have been having a very tough time. Really, they've faced a kind of three-pronged problem. Clearly, demand is down from consumers. Nobody's visiting shopping malls, of course, certainly not in the UK and at the moment and for a long while. So obviously, receipts are down for their tenants. Their tenants are not able to pay their rent. Numbers coming through that these REITs and the shopping mall owners are collecting kind of, I think it's about 40 to 50% of the usual rent in Q2, and one or two of the large ones came out with their numbers yesterday. 1st of July rent collection for Q3 was only some 15-16% of the normal. So that's a huge hit to their profitability and to their business models. Also, a lot of these tenants are stuck on long leases, and also the government intervention, particularly in the UK. The shopping mall owners can't evict tenants, due to the new government measures. So all of these things are weighing on those balance sheets and weighing on the loan to values of these portfolios. And yeah, it really is a space where we're seeing quite acute distress, and I think Into being the kind of poster child in the UK and Europe, but there are lots of others out there that are facing some significant challenges to their operating models. And again, for a distressed strategy that creates short opportunities, but further down the line, these are going to have to restructure their balance sheets. There'll be debt restructurings and things that we can get involved in on the long side further down the line.
Okay. Is it more in retail, or do you also see that in offices then? Because
yeah, no, it is both. I mean, we've been looking more at retail. We have the retail sector is something we know very well, so this is a nice kind of follow-on from that. But clearly offices, the move to out of town, the move to working from home, all of these kind of themes that are playing out. As you see, I'm really at home still myself. And this is going to play out across the board. But I think in retail, it's very acute given some of these, specialized kind of problems that they're facing at the moment. And again, it's something we're spending a lot of time on.
Reinier, thank you. Reinier, would you like to add another question?
Yeah, of course. Hi, Gareth. Can you explain a little bit what the rationale is behind the economic drop down in the energy sector, especially in US? I saw it's like minus 21%, and also compared to Europe.
Yeah, it is. I mean, the energy sector, particularly in the US, has had a really hard hit from this. The US is worse than Europe in terms of the impact. And you're right, it's about 21%. So the high yield energy sector is still down about 20% year to date. It's the worst performing of any sector in the US and Europe. Europe is a lot less impacted in the energy sector. And one of the main functions of that is that energy just represents a much larger portion of the high yield market in the US. It's about 15% compared to about 5% in Europe. So there's quite a difference in terms of size. Clearly, the shale boom in the US, there was a lot of borrowing, and a lot of companies, high yield companies, have bonds out there, big capital structures. So yeah, there is more stress in the US, and really, it's come from, of course, the collapse in demand. on the demand side, coronavirus, lockdowns, the big hit to economic growth globally and China and you name it, that's been a big impact on the price of oil, on the demand side and also on, in terms of what they can do, but also on the supply side as well. I mean, not only was there a big, fallout between Russia and Saudi Arabia and OPEC that led to this, huge price collapse in oil, with oil, futures briefly going negative, as you remember, and the forward curve in contango and people paying to store oil, and it was a very strange situation on the supply side as well. But also just trying to physically extract oil, trying to get your teams and your workers to remote venues, to the oil wells to get operating. That's very challenging under a coronavirus situation. So they've had this demand shock, a massive demand shock, and also a supply shock as well. So the upshot of that is that when you overlay those problems onto the fact that a lot of these energy issuers in the US were very highly levered, they borrowed a lot of money and issued a lot of debt. And a lot of their business models are predicated on oil being, in the 60s and 70s or even in the 50s, and it hasn't been there, for quite a while now, and it doesn't look like it's going back there very, very quickly. So, we're adjusting to this kind of new normal, and as such, we're seeing bankruptcies. We're seeing big bankruptcies and Chapter 11s in the US. So Chesapeake Energy, one of the biggest, filed for bankruptcy at the weekend, and that was long expected. White Petroleum as well, and there will be more. I mean, there are definitely more coming on that side of things. So it's a very, very interesting time for us as investors, because a lot of these companies are big capital structures. They have lots of layers of debt, different seniorities, big equity, and they will be forced to restructure their balance sheets, and that's where we can get involved and try and generate.
Well, thank you very much. This was very clear, explanatory answer. Harry, would you add another question?
Yes, I have. Thank you, Gareth. I saw your results, and March was a very difficult month for all investors, but you had a very good month in March. How come?
Yes, no, thank you. We were very pleased. We were up around 10% nearly in March on a gross basis. Clearly, it was a very, very volatile month, but really it was because of the strategy that we run. We're very much a long-short strategy in distress, which is not normal. That's not a traditional approach to distress. Most of the money in the asset class tends to be focused on more deep value or long-only type, longer lockup type vehicles. We're a bit more nimble and we're very long-short. So, in February, we started to see concerns around actually this coronavirus that we were reading about could actually be a much bigger impact on the economies of the world than first thought. And as such, we were in a position where we really did ramp up our short exposure to those sectors, consumer sectors, things like that were going to be impacted first. And that allowed us to perform very well in March. But it's saying that, we've had a very good run since then. We've added another 17% in the last 2 months. So, we're now up around kind of 22, 23% for the year. And really that's a function of the opportunity set moving a little bit, away from the short side and more towards the long side. As we are in this recovery and things become a little bit clearer in terms of restructurings and getting ourselves positioned for those. So yeah, it was very good in March. We were very happy and we positioned for it well, but really the opportunity is yet to come. The opportunity to generate real, further performance is just getting better and better. And, late this year and next year, we're extremely excited about. We really think there's going to be a lot to do.
Okay. Thanks, Gareth. Han, I think you have another question for Gareth.
Gareth, it seems a lot of distressed assets have a low ESG score. Do you take ESG scores into account when investing in distressed assets? And is that so, that is a low ESG score?
Yeah, no, Han, I think you're completely right. I mean, there's definitely a correlation there between ESG and kind of credit spreads in many sectors. It's not a blanket thing, and we're not an ESG fund. I mean, We're very clear about that. We're not a fully ESG fund. That's not what we do. But saying that, it definitely is something that we are taking into account. And really it's on two levels. First of all, you have to have an appreciation for the structural changes at the high level that ESG is having on companies. Those companies that don't adapt, to think of thermal coal, for example, the whole move away from that, that structural change is going to impact certain companies, oil companies, the obvious ones. But also on an individual level, ESG is crucial for us because the G in ESG, governance, is a big factor as credit investors, particularly as distressed credit investors. Because really, governance issues are at the root of many corporate blow-ups and many corporate collapses over the years. We've seen the high-profile ones over many years. I worked at Lehman Brothers myself, many years ago, and we've seen the Enrons of the world. But even more recently, we've seen many, governance issues. Big companies, Steinhoff, Abengoa, very recently Wirecard. Lots of big companies where these questionable governance flags were something that we spent a lot of time doing work on. And Pictet's ESG capabilities are, we joined Pictet a year and a half ago, and we've been incredibly positively surprised at how much information we have on the ESG side, and being able to analyze issuers and governance issues at a director level almost is phenomenal for us to be able to kind of stress test our ideas and our theses about red flags that we're seeing out there. And again, we can position short in some of these cases, and we have done, and that's been very good for our performance. But also, that really does come back to just knowing your kind of ESG basics and applying them and rigorously testing them over and over again.
Thank you. In the past, it was a recommendation if you have the distressed manager he was originally working at Drexel Burnham Lambert, but now it's the recommendation if you were working at Lehman. I understand.
Okay.
Yeah.
Okay, thank you, Gareth. May I invite the audience to raise a question to Gareth Payne? Is there someone who would like to give a question or bring up a question to Gareth Payne? No? Well, yeah. Zo doe ik het zo, yeah.
Thanks. Is it on? Yeah.
Yeah.
Hi, Gareth. I've been wondering about how the teams for distressed debt will cope with all the problems there will be with the companies coming forward. Because I've worked at a bank and I've seen how large these departments were handling all the difficult debt situations with the companies and how much expertise it asks, and also the big raises in interest levels they would ask. So I was wondering, is the investment world capable of dealing with this situation in the coming 2 years, 3 years?
Yeah. Thank you. Thank you. Gareth.
Yes, it's a very good question, and it's definitely going to be a big theme in the coming years. In terms of not only resources to analyze these kind of situations, but also the amount of debt that's out there and the amount of restructurings that are coming. And I think it really does come down a lot to the kind of network of people that you use as an investor. Knowing restructuring advisors in each jurisdiction, because as an investor, we focus more on Europe. That's our kind of hunting ground and where we like to operate. And Europe is a very multi-jurisdictional animal. So, the impact on each individual jurisdiction is going to be very different. And, of course, we're seeing more and more government support and, more and more central bank support coming through, and this massive wave of liquidity flooding into markets. And that is having an effect on core interest rates, and rates are staying lower, but the cost of borrowing for companies that are in distress and that are struggling still remains very high. People are still having to issue debt at very high levels, and that's not going to go away if you have structural challenges facing your business model. And particularly if you get ratings downgrades, which we've already seen, if you see more ratings downgrades, there's going to be more and more difficulty for people to service those debts. So, it is a challenge, and we are seeing it coming through more and more. But again, as I said, as a long and short investor, we are hopefully best placed to kind of target that whichever way it plays out. And, using our wide network across Europe and wide network of legal advisors and financial advisors, we can really kind of get to the bottom of each individual company level problem and make money.
Okay, thank you, Gareth. I hope you are happy with this answer. Okay, good. Right, then we are going to thank you very much for your presentation, and we'll continue with the next one. And Gareth, I already explained to the public, to the audience, that your presentation will be shared afterwards. And again, I was happy to have you here.
Thank you very much, everyone, for your time.